Q3 earnings has drawn to a close. Let's look at the winners and losers. Meanwhile, the US bond markets is betting for a Fed rate cut early next year. Let's discuss when this could be and what this means for investors. My name is Den Slim. Welcome to another episode, Monday Market Outlook. Let's take a quick look at some of the key winners and losers for this year's Q3 earnings, starting with the sectoral scorecard. Note that these are companies that are only covered by earnings calls, and it's either they beat or missed expectations. So this doesn't really mean that they lost money, right? So if analysts expect that they were supposed to earn 1 billion and they only earned 900 million, they missed expectation. But, it doesn't mean they lost money, right? So far, most sectors performed well except for retail and gaming. Of course, higher input costs greatly affected their bottom line revenues. And for the gaming sector, which is actually just, Bloomberry, this was greatly affected by the disappointing China reopening story. Of note, utilities and properties were the clear and unexpected winners for Q3. And it would be interesting to see if they can continue this trend for Q4 because they are, for me, starting to look like good bets coming into 2024. Now, just a quick summary of hits and misses for Q3. We have the top performers for Q3, Ali, Meralco, AP, Globe, RLC, AC, GT Cup, and SGP. And the underperformers, UBP, RRHI, Bloomberry, URC, ASEN, SMPH, Wilcon, and Pure Gold. It is also worth noting that ASEN is the only utility that performed below expectations, which may be a factor in the recent decline in AREIT prices, which we will discuss later. But for now, let's look at the overall scorecard. We have the top line expectations here. This means that gross revenues for the companies, So in terms of the expected sales growth, only 36% surpassed expectations and almost 60% fell short of analyst expectations. But in terms of net revenues, which is the gross revenue minus expenses, right, such as sales discounts, allowances, returns, commissions, etc., most companies actually surpassed expectations. Now, what does this mean? This means that companies didn't grow in terms of sales, but to make up for that lack of sales growth, they had to make more money this quarter or for the year, by resorting into cost-cutting measures to improve margins. Now, is this a good thing or a bad thing? Now, cost efficiency should be a good thing, right? So companies should be wise about how they use their monies. Identifying and eliminating redundancies and, streamlining costs is always a good thing. But what if you cut costs by compromising product quality? Instead of using premium quality materials, you start resorting into lower quality materials, right? So it could be also a bad thing. But overall, this has been the story for 2023, and Facebook, again, has even termed this as the year of efficiency as they started letting go of people. The thing with cost efficiency here is that you can only reduce costs by so much. It can't be reduced to zero. And the mandate for companies really is to increase sales, which can increase indefinitely. Now, what is the growth story for these companies coming into 2024? Because they can't use the same cost efficiency story for next year. So it would be very interesting to see how companies will come out, with their plans for sales growth in 2024. So let's look at the PSEI charts. The PSEI continued its rally as expected, as it reached our critical zone here to end the week at 62.69. We could consolidate in this area for this week before deciding whether the bulls or the bears will take over. But if we do manage to break out here, then a move towards 6,375, which is a strong resistance zone, could be imminent. I would really like to see the markets pull back here to 6.2 or 6,150 before continuing its rally here at 6,375. Now, analysts are saying that we could actually reach 6,500 or 6,537 by the end of the year. So let's just pray for the best. But based on price action here, at least for next week, it seems more likely that this could break out because we're not seeing any signs of reversal back to this level. But we'll see how this shortened trading week affects the market. Monday is going to be a holiday, so we will resume trading by Tuesday. Now, let's go back to some recent stocks in focus. We could be seeing both SCC and DMC finally hitting its bottom. Now, SCC bouncing back from 28, ending at 29, and DMC at 930. So, this could be a good time to ease in if you are interested in these stocks. Of course, JFC, a good rally so far for JFC. This is a good take profit zone for us, but I do like this flag formation, which tells me that it might be getting ready for another rally, hopefully towards 249. Finally, let's talk about AREIT. So like any other stock, there's no guarantee that if it touches a very strong support zone, that it will hold. It could always breach that support zone, and for AREIT, it had a strong breakdown to 29.20. At this point, we are approaching the X date here, November 30, for its dividend. So we may see further sell-off on Thursday, and the next support level will be all the way down here to 27.10, very close to its IPO price. Now, this is going to be a strong support level, I think, as those who missed the train on AREIT when it IPO'd will have a chance to buy a great REIT at close to its original IPO price. At this current price level at 29.20, the yield has now gone up to 7.26%. So why did AREIT shares go down? Last Friday, AREIT announced a share swap agreement with ASEN to acquire land in Zambales to add renewable energy properties to its portfolio. While this could be good news for AREIT as it continues to expand and diversify its business, we are looking at a possible dilution of shares in the next few years, because what happens when this deal pushes through? The current public float of AREIT is at 33.76%. With this agreement, the public float will go down close to 30%, which is dangerously close to the minimum public float required by the SEC. So there could be a follow-on offering in the next years, which could dilute the earnings per share of AREIT. So foreign investors didn't like it, and they had a huge sell-off of AREIT last week. Now, looking at the AREIT ASEN share swap deal timeline, this is not going to happen tomorrow, right? AREIT will apply to the BIR for the certificate of authorizing registration by March 2024 next year. The approval is expected to come out of Q3 2024, by which time AREIT can now start accruing income for the newly acquired properties. By Q4, they will get BIR approval, and it is only by Q2 or Q3 of 2025 when they can start listing shares. As we've discussed in previous episode, REITs are dependent on interest rates. Looking forward to 2024 and 2025, what would rates look like by then? We are at 6.5 right now. Do we get a rate cut in June? Do we get a rate cut on November? Or both? Or how about 2025? So if we do some calculations, if we do get a 50 basis point rate cuts in 2024, the corresponding yield or the price adjustment for REITs will come out at around 31.41, and if we reduce by 100 basis points by 2025, that goes to 33.92. Now that's expecting the yield remain steady at 12, but usually AREIT yields go up every year. So it would be interesting to see the interplay of these factors in the next 2 years and how this affects AREIT prices moving forward. But again, for me, AREIT is a great REIT, and this reaction to the share swap deal could be a good opportunity for investors to buy back into a great asset. So on to the global markets. The S&P 500 posted its best win streak since June as it ended its week on a Black Friday on half-day trading. So going to the S&P 500 charts, we look at that rally. Wow, we've said that this is a gap fill level now. If you look at the SPY here, this is a gap fill level at 455, and we were able to fill that gap last week. Now, it closed the week at 45.58, and as of the moment, also, there are no signs of a turn, and it is highly likely that we could see the S&P 500 grind towards 4,600. Now, this could be a very interesting zone to watch out for in the coming weeks as we wrap up 2023. And as we look into some seasonal charts, historically, beginning the Tuesday before Thanksgiving, which was last week, running up to the second day of next year, we have a 79% win rate since the 1950s. So this is really great news for the bulls to end the year, which also adds to the idea, if we go back to the charts, this adds to the idea that yes, we could be grinding towards 4,600. So if we look at the charts so far this year also, we have tracked the seasonality charts very closely. Or the steep line here going towards the end of the year could be signs of good things to come. But as we look ahead, for next year, 2024, will be all about the anticipation for rate cuts. When will the Fed cut rate? Based on the probabilities here, the odds for a May rate cut has even increased to 50%. Now, looking at the rate cuts on a global scale, it's worth noting that we are starting to see more central banks around the world starting to cut rates. We can see here at the peak of rate hikes, 81 central banks around the world hiking rates during 2012, and we are starting to see a trend towards cutting rates as we proceed towards the end of 2023. So next year, rate cuts will most likely happen, and everybody is just asking when. So, but for me, it's not a question of when, but what exactly happens to the markets when the Fed pivots. Now, let's look at this chart. We presented this earlier this year, and we warned that a Fed pivot may not necessarily be a good thing. But let's look at the previous times that the Fed cut rates. Here, we have the dot-com crash, down. Again here, a Fed pivot, markets went down. Fed pivot, market went down. Right? So, for how long and for how low, again, we go back to our charts. History suggests an average of 23.5% drawdown and an average of 195 days. It could be shorter, it could be longer, it could be a lesser drawdown, or it could be a higher drawdown. We don't know. But one thing I noticed, and we don't monitor this too often, but taking a look at the IWM or the Russell 2000, these are the small cap stocks. So during rate cuts, we tend to see the Russell 2000 outperform the S&P 500. See the blue area here, which represents quantitative easing cycles. Small caps tend to lead the markets. So the small caps or the IWM ETF could be worth looking at for 2024 as a good addition to your portfolios, especially as we anticipate a potential rate cut by the Fed in 2024. So let's look at next week's economic calendar. We are looking at the consumer confidence numbers as well as some income numbers, which will give us some data on how the Fed decides. Wage numbers are still an issue, so it would be interesting to see the personal income numbers on Thursday. So we will also see the PPI numbers for the Philippines as well as our manufacturing numbers on Thursday. We are looking at a slowdown to 52 from 52.4, but this still puts us in expansion mode, in contrast to the US numbers, which are contracting, forecasted at 47.2. So that's it for this week. Do enjoy the long weekend. Please like this video if you found the information useful. Please subscribe to the channel for more updates. And again, good luck on your trades. Please manage your risk accordingly. And I'll see you again next week.